Jay Powell's going to have his work cut out working with Scott Bessent, to try and, sort of manage some sort of stability in really what's going to be a crisis. Because, the worst possible thing from the point of view of a Keynesian, which is what we have, or neo-Keynesian macroeconomists, is something which they just don't understand. They think that you get a recession, interest rates go down, prices go down. No, they don't. What we're looking at is a recession, and at the same time, rising bond yields, rising interest rates. It's a real killer, and that's the whole point about the biggest credit bubble in history.
Good evening, investors and market watchers. This is your gold and silver economic briefing. I'm your host, bringing you today's critical insights at the intersection of precious metals, geopolitics, and financial markets. Veteran economist and precious metals authority Alasdair Macleod has issued what some are calling his most urgent forecast yet. Let's break it all down.
It's the destruction that he has wrought on markets by, as I said earlier, every time he talks about China, he seems to he says, I'm going to make it 245% tariffs. Hold on. This is a man who actually doesn't understand what, his responsibilities. And not only that, but you have all these executive orders coming out of the White House, which, has he really got the power to do this? You sort of think this is not actually, basically he's doing things that Congress should be doing. If Congress passed these policies, which I would very much doubt a lot of his policies, that's actually their responsibility, not the president's. He's weaseling around the law to basically take total dictatorship over American policy. And his latest example of this, of course, is on interest rates. He's trying to take it away from the Fed. This is just so dangerous. And, I think that he has been sat on because quite clearly he's quietened down. And I think he's just been told, look, shut up. When you've now got to ask yourself the question that having sort of embarked on this fairyland idea that he could replace income tax with tariffs and so on and so forth, like they did before the First World War or whatever, what's going to happen now? That's obviously not going to happen. Whether there is going to be any increase for revenue from tariffs, we'll have to see, but there's a huge question mark over that. What's going to happen now that he's really given a kick into a recession? He's just kicked the economy downstairs. What's going to happen to the budget deficit? It's going to rise, isn't it? Can he cut taxes? No. If he tries to cut taxes, he'll get punished. It's simple as that. He no longer has the power to do this, because I think that Bessent and his officials have now got his measure. Trump has basically made the mistakes. He has proved to be totally incompetent in terms of fiscal policy, in terms of economic management, and even politics, I would say. He's just basically bullied his way through. So now that the state is getting Trump's measure, this is not quite so nice. I think the deep state basically is getting back into power, if you like. So we go from Sleepy Joe to Sleepy Trump. This is going to be, I think, the way it goes, because, if you start losing, if you're in a position of power, a total power, and you start losing it, because you've made some fundamental errors, basically you're on a downhill slope. In terms of losing that power, you just lose credibility. And the loss of the president's credibility will affect the loss of the dollar's credibility. And as I say, we've got this huge, great credit bubble, the other side of which is debt. And it's debt that everybody's looking at, abroad anyway. And you can see that, if the debt is going to be a problem, which basically means that the cost of debt in the form of interest rates is going to have to rise in order to sustain that debt, as it were, then under those circumstances, what does that do to the economy? The economy starts falling apart because it cannot afford higher interest rates because it's full of zombie corporations. The level of interest, annual interest cost on the federal government is already greater than the entire defense budget. Everything starts going wrong. And this is the problem. And I think it's even too early to say that with the state, if you like, the permanent establishment, helped by people like Scott Bessent, who's actually a pretty sensible guy, trying to sort of calm things down, I don't think it's going to work because we're popping a credit bubble as well.
First, the macroeconomic backdrop. We are standing at the precipice of a perfect storm in global finance. The largest credit bubble in history, yes, in history, is on the verge of popping. Contrary to traditional Keynesian expectations, we are facing a rare and dangerous combination, a recession unfolding alongside rising bond yields and interest rates. Typically, rates fall during recessions. Not this time.
Financial markets under these circumstances. The US large banks are not as leveraged as they are in the EU or in Japan. And I think that there has already been a pretty good shift away from lending to small and medium-sized companies into lending to the government in the form of buying T-bills, that sort of thing. That's already, I think, happened to quite an extent. As far as the EU is concerned, I don't have quite the same feeling. I think that they have been starving business of credit. Japan, I haven't got much of a clue on, I must admit. But then, there's just such a huge government bond market in Japan. And I think that's really where so much of the commercial banking obligations are already. And of course, they get undermined by rising interest rates. We've seen a certain amount of disruption there in the past. That seems to have died down for the moment, but I suspect that a lot of that is because a lot of carry trade stuff has been basically washed out of the system by, if you like, the sort of Trump tantrum, the Trump tariff tantrum. The banks are definitely, in both the EU and Japan, are both definitely very highly leveraged. I'm talking about the big ones. And of course, the other thing we've got is we have got the over-the-counter derivatives, and also linked to it very, very much because there's the other side of a lot of risk being laid off. You've got regulated derivatives in the form of futures. Now, I can see that. I think what's happened is that when it comes to gold, the big banks have basically got themselves straight. I mean, notice how they now seem to be quite happy. Their analysts seem to be quite happy, saying, we forecast gold going to $4,000 or whatever it might be. And while I think it would be wrong to say that the analysts are very much in the pockets of the book, I think they would be quite restricted from that sort of comment if it was very much against the interests of the book. So I can only conclude that the big banks have basically got their gold position straight. What we don't know is whether those gold positions are straight on the basis of paper or actual physical. I suspect quite a lot of it is physical, and I think quite a lot of the gold that migrated from London and Switzerland over the last 2 months into COMEX warehouses is part of that physical build-up, I think, for some of the larger bullion banks. But if you do get a crisis in the precious metal derivatives, then that is going to impact, I think, the entire over-the-counter derivatives system. And there we're talking about potentially trillions. So, yeah, I mean, it's very easy to underestimate. I mean, we've seen the dollar fall get on a trade-weighted basis by something like, 10, 11%, I think, in April. And that fall, you sort of think, well, okay, so what? But think about the quantity of dollar credit in issue. It is absolutely enormous. The consequences of that 10% fall are very, very substantial. Going from, what the foreigners actually own in terms of financial assets in the...
This scenario is devastating for debt-laden governments, zombie corporations, and over-leveraged banks. It's not just an academic concern. This is the sort of event that can wipe out wealth for the unprepared and create once-in-a-generation opportunities for the strategic investor. Let's look at gold and silver dynamics across the globe. In India, record-high prices have driven gold discounts to a staggering 9-year peak. Dealers are offering up to $80 per ounce below official prices. Jewelry sales have plummeted, with many buyers pulling back, even during the traditionally strong Akshaya Tritiya festival. Meanwhile, in China, the world's largest bullion consumer, premiums have surged to a 1-year high, triggering heavy import activity. This signals that, while casual consumers retreat in some regions, serious investors and central banks continue accumulating gold aggressively. Silver has also made headlines, surging near $33 an ounce as fears of an all-out US-China trade war ease. Despite diplomatic posturing, industrial demand for silver remains robust, powered by sectors like electric vehicles, electronics, and renewable energy infrastructure. But the deeper message from Macleod? It's not just about today's price action. It's about the structural shift in the financial system. Here's why. Macleod explains that the Federal Reserve and policymakers are now trapped. With debt servicing costs already surpassing the US defense budget, there's no room to cut taxes or meaningfully reduce deficits. Political instability, highlighted by erratic trade policies and power struggles in Washington, is only adding fuel to the fire. Investors, take note. As the dollar loses credibility due to fiscal mismanagement and rising debt costs, precious metals are stepping into the role of alternative wealth protection once again. In the banking world, large U.S. banks have largely hedged their gold positions, possibly shifting into physical gold rather than paper instruments. There's credible speculation that recent gold shipments from London and Switzerland into U.S. COMEX warehouses are part of a larger move by bullion banks to prepare for market disruptions. And the biggest risk? Macleod warns that any crisis in the precious metal derivatives market, which underpins trillions in global financial contracts, could trigger a systemic event affecting all markets. Such a disruption could make the 2008 financial crisis look like a minor market correction by comparison. As Macleod puts it, real wealth is built when sentiment is low and opportunities are overlooked. Right now, many investors remain distracted by short-term headlines, but seasoned players are quietly positioning for what could be a new commodity supercycle, driven by years of underinvestment and tightening supply chains. So, the critical question for all of you watching tonight: are you prepared for the biggest move in gold and silver in modern history? Or will you be among those left scrambling when this credit bubble bursts and the flight to hard assets accelerates? We'll continue to monitor these fast-moving developments. But one thing is certain: this is not the time for complacency. If you found this briefing valuable, don't forget to subscribe and turn on notifications. And for those serious about maximizing your precious metals strategy, be sure to explore the Stacker's Handbook and the latest numismatic opportunities, because in times of uncertainty, knowledge and preparation are your greatest assets.